So we have this question called Ryder. What are we asked to do? Always start off with the requirements. It says discuss the accounting treatment of the above events. It's not a 25-mark question though, is it? Because the examiner has kindly split it into 4 parts for us. And also, in the very first paragraph, there's some interesting information. It's reviewing certain events which have occurred since its year end. So we could be dealing with events after the SFP date. So we need to be able to apply that to all of these issues as well. So we're going to go through it bit by bit, line by line, and to try to generate an answer which is going to earn us marks. So the first thing we've got is the crop disposal. Now, when did this disposal take place? The disposal took place on the 10th of December X5, and the financial statements were authorised on the 12th of December. So the disposal took place during the adjusting period for events after the SFP date per IFRS. This is because they occurred before the 12th of December. So we've disposed of a wholly owned subsidiary. At the year end, we had no intention of selling the subsidiary. So crop should not be classified as a discontinued activity because there was no intention to sell. At the SFP date. So I'm dealing with events after the SFP date. I'm dealing with a little bit of IFRS 5. I'm trying to all the time, and I'm looking at 6 marks here. I'm trying to get a mark per point at least. The sale at a loss gives additional evidence that crop was overvalued and so an impairment was needed at the SFP date. So we made a loss of 9 million on the transaction, and we're also told that Krupp made a loss of 2 million in the period between the year end and the sale date. The impairment is the loss on sale of $9 million plus the trading loss of $2 million. Because recoverable amount takes into account future cash flows at the SFP date. So can you see I'm breaking the question and making singular comments, and I'm using the word because as often as I can. The total impairment of $11 million should be offset. Well, if you have an impairment, and here we're dealing with a cash generating group, against the assets of a cash generating group, initially against goodwill. Now, if we take a look at the question, the net assets of Krupp were 20 million and goodwill was 12 million. So we can do the full offset against goodwill. This will reduce goodwill to $1 million at the SFP date, because I'm going to credit goodwill 11 million and debit profit or loss with my impairment with 11 million. So I've tried to get enough points across to earn me the 6 marks. Now I've done a slight boo-boo here, in the sense that I've not left enough room to write any other pages. So part B is going to be mucking around with the pages, but we'll sort that out later. The next part of the question is in respect of a company called Metallic, and this is an acquisition. Well, acquisitions of subsidiaries are dealt with in F7, aren't they? There's no complications here. It's even it's a wholly owned subsidiary, so no NCI to worry about. Goodwill is the fair value of the consideration and this is calculated based on IFRS 3 rules. So we've got consideration. It was 2 million shares of Ryder immediately, plus a further 300,000 shares if the profit of Metallic exceeded a particular target. The additional 300,000 shares are only included as contingent consideration if it is probable they will be issued. Now, we're told that those shares will be issued if the profit of Metallic exceeded $6 million for the year ended the 31st of October X5. The profit for the year of Metallic was $7 million, and the ordinary shares were issued. And the annual profits had averaged $7 million over the past few years. So we'd included the contingent consideration at the 21st of January X4. These shares should be included within consideration because profits had exceeded the target for a number of years. The fair value used for the ordinary shares of Ryder at this date included the contingent consideration was $10 per share. The fair value of the shares at the 12th of November X5, which was the issue date, was $11 per share. The shares should be measured at their fair value at the acquisition date on the 21st of the 1st X4. Of $10 per share. This means we would debit cost of investment 300,000 times $10 . So we debit the cost of investment $3 million. And we credit equity $3 million. The bonus issue on the 13th of the 11th X5 is a non-adjusting event. Because it does not affect the number of shares in issue. at the 31st of the 10th X5. We therefore merely disclose this bonus issue in the notes to the accounts. So I've broken down the question into the contingent consideration and the bonus issue. Again, I'm not writing, do you see, I'm not writing huge amounts, but I'm using, because I'm using, do you see, all my points are separated, bullet point, bullet point, bullet point, 2, 3 lines, 2, 3 lines, 2, 3 lines, and each of those is going to be worth 1 to 2 marks. My target mark is 4. Are you going to give me at least 4 marks? Yeah, I think I'll probably get at least 4 marks there. So you don't have to write huge, you know, I'm not expecting War and Peace, but I'm hoping that we'll come up with something which is relevant. Part C, we acquired a property on the 1st of November X4 which it intended to sell. It was obtained as a result of a default on a loan agreement and was valued at 20 million. The property is in a state of disrepair and we intend to complete the repairs before we sell the property. The repairs were completed on the 30th of November. Now, the company has classified this as held for sale. Well, the first thing I'm going to say is we cannot classify the property as held for sale because it was in a state of disrepair. At the year end. Under IFRS 5, you can only classify something as being held for sale if a number of conditions are met, one of which it must be available for immediate sale. So per IFRS 5, assets must be available for immediate sale. And the fact that this building required some repairs suggests that it was not in that condition. The company has classified it as held for sale and it's shown it at the ultimate sale price of 27 million. Well, the property should have been valued at $20 million at the 1st of the 11th X4 because this was the value of the debt foregone. We're owed $20 million. They can't pay us. We've accepted a property, so we're going to go credit receivable, debit PPE 20 million. Although IFRS 5 states assets should not be depreciated once classified as held for sale. This property fails the classification test. Ryder should therefore depreciate the property by 5% of 20 million, which is $1 million, the property will therefore be shown within PPE at the 31st of the 10th X5 at a carrying amount of the cost of 20 million less the depreciation, so we got a carrying amount of 19 million. The sale of the property the property was sold after costs for 27 million on the 9th of December, so the sale of the property on the 9th of December is a non-adjusting event. Which should be disclosed as a note to the accounts. Do you see, in each of these events, because I spotted in the first paragraph that all of the events took place after the year end, I'm picking up a mark every single time by classifying as adjusting or non-adjusting. So I'm picking up, if I do this for the 3 or 4 items, I'm picking up an extra 3 or 4 marks. Finally, part D. So here we've got share appreciation rights. And these were granted on the 1st of November X3 based on 10 million shares. The rights vested on the 31st of October X5. And payment was made on the 1st of December X5. So the payment is our non-adjusting event. We're not going to show that, but we are going to have to deal with everything else. At the 31st of December X4, the SARs would have been measured using the fair value at that date. This is because they are cash settled. The SIRs provide employees at the date the rights are exercised with the right to receive cash. They're not going to get shares, they're going to get cash. Therefore, at the 31st of the 10th X4, a liability of, what's it going to be? 10 million shares at the 31st of October X4. It's $6 per share, and we are 1 year into a 2-year scheme, so a liability of $30 million would appear in the SFP. At the 31st of December X5, we remeasure using the fair value at that date of $8 per share. So that's going to be 10 million options times $8 per share, and we are 2 years into a 2-year scheme. So that gives us a total liability of 80 million. Therefore, we're going to debit profit or loss with the increase. So we've gone from 30 million to 80 million. So I'm going to debit profit or loss 50 million. And we're going to credit the liability 50 million. The liability will be transferred from non-current to current. Because if you think about it, at the 31st of October X4, the due payment date was December X5, so it was more than 12 months to go. At the end of this year, we're going to expect to make the payment out in a few months, few weeks. So again, it's worth an extra mark. Every discrete comment that you make, the marker will go, yeah, that's relevant, give them a mark. Yeah, that's relevant, give them a mark. We're then told at the 1st of December X5, the value was $9. The increase in the share price to $9 by the 1st of the 12th X5 is a non-adjusting event. And will appear in the financial statements for the year ending the 31st of the 10th X6. Now, this is, I mean, if you look at this question, this is a 2005 question. It's only sort of in the last 3 or 4 years where the examiner has been expressing the fact that he wants presentation and professionalism to be taken into consideration, and that's come as a diktat from ACCA. So I would normally have expected 2 of the marks to be allocated for style and presentation and professional formatting of the way that you write. So, you know, I'm reasonably confident that I would have got, you know, into the 20s with my answer. It wasn't very long, that answer, and I'd cranked it out in less than half an hour. So what I'm trying to emphasize is people think that P2 is a very intimidating exam, and it is, but to earn a good mark, you don't have to write pages and pages and pages and for hours and hours and hours. What is important that what you do write is A, relevant, and B, well communicated.